Hello everyone and welcome to the quickfire revision for Ind AS 113 fair value measurement. Now this is a relatively new standard which was not there in your CA Inter AS, and it was much needed in Ind AS due to the well-known obsession that Ind AS has with the term fair value. So over here this standard gives you guidance on what is to be used or what are the principles that need to be followed in the fair value determination process. So how is fair value defined? There are 5 main pillars that go into the fair value determination. First, fair value is a price that you receive if you were to sell an asset or transfer a liability. That is, it is an exit price. So over here, if you were looking at, let's say you had gold and you had gold ornaments, if you go to buy gold, you are charged, let us say, the price along with the making charges. So that is the entry price. Whereas when you go to sell that gold, you are given the gold price after making certain deductions. And hence, the value of the gold ornaments that you have should be which price? Sir, it has to be the exit price. That is the price that I will get if I were to sell the asset. Similar is the case with dollars. If I have certain dollars and if I have to find the fair value, the price that if I were to get, if I were to sell the dollars to the dealer, what is the price? That is the exit price. So fair value is defined as the price that you get if you were to sell the asset to a market participant. Again, the price valuation over here is not entity specific, it is specific to what you call as a market participant. That is, let us say if you have a commercial, if you have a vacant plot of land which can be used for commercial purposes as well as residential purposes, then which value should you take? Well, we will take the value, what a market participant can do with the asset. Certain times question will tell you that you are a company which is engaged into only residential real estate, and hence, should you take the price only of the residential real estate? No. You can use the land only for residential real estate purpose, but we are not finding the value in use like you do in impairment. You are trying to find the fair value. And fair value is what? A market participant, that is a regular participant in the market. What can he do with the asset? Well, he can use it for the residential purpose or even the commercial purpose. So you will probably take the highest and the best value. So it is the price that you get if I were to sell the asset to a market participant in the appropriate market. What is an appropriate market over here? The appropriate market can be the principal market. That is a market where the volume of trading is so high that it overshadows every other market. Like for example, if there's a share which is listed like Infosys on the BSE as well as on the NYSE, New York Stock Exchange, in which case the volume on BSE is thousands of crores, where the NYSE is a few crores, in which case we will say that BSE is the principal market. However, is it necessary that every product has a principal market? No. Or another example would be, let us say you have an Ayurvedic company like Dabur who is selling Chyawanprash. Let us say 95% of its products are sold in India, 5% are sold in the export markets. So 95% are sold in India, so India is the principal market. However, if there are shares, let's say who are listed on BSE and NSE, and both of these exchanges have a fairly decent volume, so none of them can be categorized as principal. Or let us say you are dealing in diamonds, let us say, in which case the local and export are broadly 50-50 of your sales, in which case none of them is principal. In such case, how will you find the fair value? Because the prices may be different in different markets. You will take, in such cases, the most advantageous market. Remember, the most advantageous market is going to be the market where you get the highest net proceeds after considering. So you will take the available price after considering the transportation cost as well as the transaction cost. So the market which gives you the highest net proceeds after considering both the transportation and the transaction cost will be taken as the most advantageous market. One needs to remember that when you go to the assessment of the most advantageous market only if there's no principal market. If there's a principal market for your products, you will take the fair value in the principal market only. Again, the 3 principles that you've done till now: fair value is the price that you get if I were to sell the asset to a market participant in the most appropriate market in an orderly transaction. The 4th point is an orderly transaction, which means it is not a transaction between 2 related parties or not a transaction under distress. The valuation transaction that you're taking as a base is an orderly or a transaction where participants have done their dealings with full information and there is no other related party consideration or any other distress, etc. on the valuation date. So it is a valuation happens as on a date and not for the period. So the valuation happens as on date. You cannot say the price of the share is the average price of the last 6 months. No, it is a price today. So what are the 5 things that we need to remember when we look at the fair value? Fair value in simple terms is the exit price that is market participant specific in the appropriate market in an orderly transaction at the measurement date. So over here we have kind of explained at length what the appropriate market is, what do you mean by market participants, orderly transactions, etc. Now once you determine what is the appropriate market, it may be principal, and if there is no principal, then most advantageous. Then comes the determination of fair value. Fair value, remember, as per 113 is calculated as the available price that you calculate using certain level 1, level 2, level 3 category inputs that you will study further. The available price that you calculate after considering the transportation cost, but without deducting the transaction cost. Now this is where students get confused. Sir, in most advantageous market, yes, for determination of most advantageous market, you have to consider the net proceeds in hand. What do you get? The market which gives you the highest in hand proceeds is the most advantageous market. However, once you determine the most advantageous market, or if there's none, or if there is a principal market, if you take that, if you have to determine the fair value is determined as the available price, which can be determined using level 1, level 2, level 3 category inputs that we study in some time, minus the transportation cost. Sir, but what if there's a transaction cost, and what is the difference between transportation and transaction cost? So for example, if I'm looking at a commodity like mango, for example, and my appropriate market is determined to be the Middle Eastern market, where let's say most of my products are being sold in Arab countries, then I would say that okay, the Middle Eastern market is my most appropriate market, in which case I would have taken the selling price that I get in the Dubai market, for example, as a base. However, these mangoes have to reach Dubai, and hence the transportation cost has to be incurred. So I might be getting, let us say in rupee terms, 1000 rupees on the mango, but I have to spend 300 to take those mangoes to the Dubai market, and hence my fair price would be, let us say 1000 minus 300, that is the transportation cost, that is 700. However, if I want to do a transaction in the Dubai market, like in India you have APMC, Agriculture Produce Marketing Committee, let us say in Dubai also you have a similar committee, so you have to pay certain transaction charges. Like in stock exchanges you have to pay STT, which is like a transaction cost. It is not a cost to transport the shares, it is a cost to transact in the shares. So in Dubai, let us say you have to pay 100 rupees, which is the cost to transact. Let's say it is sold in an auction, or it is sold through an APMC market, in which case 100 is the transaction cost. So the standard over here says that the fair value is 1000, that is the price that you get in the Dubai market, minus 300, that is the transportation cost, so 700 should be the fair value. Sir, but what about the transaction cost? Well, it depends. If certain standards like Index 41 tell you to measure something at fair value less cost to sell, then you will also subtract 700 minus 100, that is fair value, 700 minus cost to sell, that is 100. Or if there are certain standards like Index 109 which tells you to measure at fair value, FEDPL, FEOCI, they ask you to measure at fair value. So I might have a share of Reliance which is worth 2500. However, if I sell it, I'll have to pay brokerage, that is a transaction cost, but Index 109 does not require me to reduce it. And hence the standard says, well, if transaction cost has to be subtracted separately, then it will be told in the standard. Otherwise, fair value is your available price minus the transportation cost. You will not subtract transaction cost to determine fair value. Yes, if you want to find fair value less cost to sell, then separately under the respective standard you can subtract the transaction cost or the cost to sell, as the case may be. So this is a very important point of consideration, and multiple times problems have come where you have been asked to first determine the most advantageous market, where you subtract both transportation and transaction cost, and once that market is determined, you're asked to determine the fair value, where you just subtract the transportation cost and not the transaction cost. Okay, now the standard also gives you certain guidance on the valuation of non-financial assets. Remember, non-financial assets, let us say like land, have multiple uses. It can be, a land can be used for residential purpose, commercial purpose, agricultural purpose, mining purpose, any purpose. And hence, what base should be considered for the value determination? Here the standard says, from the perspective of market participant, what is the highest and the best use? Irrespective of what the entity wants to do, what is the highest and best use of that non-financial asset, that should be considered. Again, while determining the highest and best use, you will consider the current use, unless given otherwise to be the highest and best use. However, if there is an alternative use available, which is used by market participants in that locality or in that area or in that market, then an alternative use will be considered, and the highest and the best use, considering both or more than two alternatives as the case may be, will be taken for the purpose of valuation. Standard gives you guidance that while doing so, you should also consider the fact that if there is any expense which is incurred, like demolition cost, to bring the asset ready for the alternative use, that should be subtracted in while determining the fair value of the alternative use as well. So there is certain guidance about the non-financial assets where we take the highest and the best use. Then you go to the valuation method. So over here, what is the golden rule of valuation? The golden rule of valuation is you select a valuation technique which maximizes the use of observable inputs and minimizes the use of unobservable inputs. Now, the available price that we said of mangoes in the Dubai market, how would that be calculated? Well, that will be calculated by applying this principle that you will try to maximize the observable inputs and minimize the use of unobservable inputs. Now, what are observable inputs? Observable inputs are those inputs which you can derive from active quoted markets. Observable inputs are those inputs which you can derive from active, let us say, quoted markets, and these are independent of that of the entity. So there is a paper trail, there's a kind of an audit trail where entity is not doing any forecast. You can determine the price. Like for a share, for example, you can take the price from the exchange, which is independent of the entity. That is an observable input. However, if your share is unlisted, you can do a Gordon's formula measurement and try to determine the value of the share. However, Gordon's formula is based on forecasts, dividend or cash flows, cost of equity, growth, which are all forecasts. So they are not from an independent source, and hence they are unobservable. So over here, this is a very good guiding principle, because earlier what used to happen is, let us say if the share price has gone down significantly, then instead of taking the market price as a fair value, people would say that, well, the market has overreacted and hence we have done our valuation and the fair value as per Gordon approach is so and so. But before 113, there was no way in which an auditor could have qualified and said, well, you know what, this is violation of standards. But now the standard has told you that you have to take a method which maximizes the use of observable inputs, reliability, and minimizes the use of unobservable inputs. And for doing so, they have also given you what is called as a fair value hierarchy, where they have segregated the inputs into three broad categories: level 1, level 2 and level 3. Level 1 category inputs are prices of exactly identical assets from an active market. For example, if you are having a 24 karat gold bar and you go to the market and on MCX, multi-commodity exchange, there is a 24 karat gold bar which is trading at, let us say, 60,000 for 10 grams, in which case you have the price which is available for an identical asset in an active market, and hence that should be taken as a base. You will apply no other technique. However, let us say on MCX there's a 24 karat gold bar and a 22 karat gold bar, let us say, which are traded. However, you are somehow sitting on a 23 karat gold bar. Now, there is no active market for a 23 karat gold bar. However, there are similar assets. There is a 24 karat and a 22 karat gold bar, and you can make certain adjustments and, loosely speaking, derive the value of a 23 karat gold bar. Now, this is using observable data of a similar asset, though not identical, similar asset plus or minus certain adjustments that will be the valuation based on a level 2 category input. However, in certain cases, there is no identical asset. Let us say if I'm a company like SpaceX. Now, I am not listed. I construct satellites. I don't have a similar satellite construction company which is listed, in which case, if I have to do the valuation, I will have to do the valuation considering the present value future cash flows. So I do financial forecast, that is level 3 category. Level 1 is the prices of identical assets in quoted markets. Level 2, prices of similar assets, like Parle is unlisted, Britannia is listed. So you take the valuation of Britannia, make certain adjustments to find the value of Parle. Level 2 category, if there is no identical asset, your share is also not listed, then you do financial forecast, that is level 3. So the general rule is you should try to select a valuation technique which maximizes the use of level 1 or observable category inputs and minimizes the use of level 3 or unobservable category inputs. Now, the standard also gives you certain guidance regarding valuation techniques. Again, remember, these valuation techniques have to be applied if and only if you need to do a separate valuation where the quoted market price of identical asset is not available. If that is available, you don't need to do any separate valuation method. So there are three guidance based techniques given: market approach, where you look at the multiple of a comparable company like a PE multiple and multiplied by the EPS of our company to find the value. So this is usually level 2 category input. Income approach, where you take the present value of the future cash flows and the terminal value to find the value today, which is usually a level 3 category input. And then asset or cost approach, where you typically take the net assets. Again, that can be 1, 2 and 3 depending on whether the assets, like for a mutual fund, they are all quoted, whether the assets are level 1, level 2, level 3 category, etc. Again, you are doing an FR paper, not an SFM paper, and hence too much of valuation is not going to be asked. However, if it is asked, questions might give you certain adjustments, like they might give you the firm value, and from that they might ask you to find the equity value. You will do this in SFM, but that is firm value minus the value of debt will give you the equity value. And while calculating debt, you will take the net debt, that is total debt minus the cash. That is one common adjustment. Certain questions will give you discount, like a liquidity discount or a non-controlling interest discount. If a discount is given, so you will say that the other company is a listed company and hence its value will be higher as compared to my company which is unlisted, and hence there might be a liquidity discount. If there's a discount, you will subtract it from the final value derived, and so on. Okay, so I guess this gives you kind of a broad gist of the standard. I hope you have got a good understanding. Let me know if you need any other help. Till the time, good luck, goodbye, and study hard.